6th, 2026. Write these numbers down. Silver, $75.41. Gold, $4,632.90. That puts the gold to silver ratio at roughly 61 to 1. Now, here's where it gets interesting. COMEX registered silver, the metal most readily available for delivery, sits at about 79 million ounces, and in the retail market, a 1-ounce American Silver Eagle is selling for over $90. That's a massive premium over spot. So think about this. Silver is outperforming gold. The ratio is compressing. The market is in its 6th straight annual deficit. Inventories have been declining for years, and physical silver is still selling far above paper price. Yet the dominant narrative says the squeeze story is over, finished, done, old news. Those two realities don't match. Either the market has fully normalized or the stress never actually left. It just became less visible. And if that second scenario is even partially true, then what happens next won't be driven by headlines. It will be driven by inventories, delivery behavior, and physical demand. Stay with me, because the silver squeeze story might not be dead. It might just be harder to see. I'm boring stocks. This channel focuses on calm, data-driven market analysis, not hype. This is educational content only, not financial advice. Always do your own research and consult qualified professionals. Now let's break down what's actually happening. As of today, silver is up about 2.5%. Gold is up around 1.4%. Silver is outperforming. At the same time, the US dollar is slightly weaker, Treasury yields are slightly lower, and risk assets like Bitcoin are still active. So yes, there's a normal macro explanation, but here's the problem. That explains why metals are rising. It does not explain why silver keeps outperforming gold, while the physical market still shows signs of stress. That's where things get interesting. There are 4 key data points. First, the deficit is real. The market is still consuming more silver than it produces. Second, investment demand is rising again. Retail buyers are coming back into the market. Third, we already saw real stress. Lease rates spiked dramatically in 2025, a clear sign of tight liquidity. Fourth, inventories have been draining for years. Hundreds of millions of ounces have already been pulled from global stockpiles. Put that together, ongoing deficit, rising investment demand, recent stress signals, and long-term inventory drawdown. That's not a fully relaxed market. Think of silver in stages. At first, the market looks normal. Then, deficits begin, but instead of prices exploding immediately, inventories absorb the pressure. That hides the stress. Over time, behavior changes. Participants become more cautious. Liquidity tightens. Eventually, visible signals appear. Higher premiums, rising lease rates, delayed delivery. And that brings us to today. Not a panic market, but not a fully healed one either. This is where the divergence becomes obvious. Spot silver is around $75, but physical silver? Still selling far above that. Premiums are double digits, in some cases over 20%. And in certain listings, delivery isn't immediate. That's friction. It's not proof of a shortage, but it's not a frictionless market either. And COMEX registered inventory? Still relatively limited compared to total stock. So while paper price looks clean, the physical side tells a more complicated story. Normally, paper price and physical conditions move together. Right now, they're not. We've seen signs of tightness, but not a full price response. And silver isn't just rising, it's outperforming gold. That matters. because silver sits between two worlds, industrial demand and monetary demand. When both start aligning, that's when things can change quickly. Here's the simple math. Supply is declining slightly. Demand is still higher than supply. That creates a deficit, and most silver isn't mined directly. It's a byproduct of other metals, which means supply doesn't respond quickly to price. So when demand rises, the gap is filled by inventory. That's the key. Now, the counterarguments matter. Industrial demand could weaken, substitution could reduce usage, supply could eventually respond. All true, but timing is everything. Even if those changes happen, they don't happen instantly, and in the meantime, the market can stay tight. Here's what actually matters going forward. Watch premiums. If they stay high, tightness remains. Watch inventories. If they fall, pressure builds. Watch the gold-silver ratio. If it keeps compressing, silver is gaining strength. And remember, silver can go down. This thesis can be wrong. Markets can take longer than expected. Always manage risk. Let's bring it together. Silver is rising, but more importantly, it's outperforming. The macro explanation is valid, but incomplete. Because underneath the surface, the data still points to structural tightness, ongoing deficits, inventory drawdowns, physical premiums, and recent liquidity stress. The question is simple. Is the current price already reflecting that reality, or is the paper market still underestimating it? That's what you need to decide. If this breakdown helped you think more clearly, subscribe. I'll keep tracking the data and update you as the story evolves. I'm Boring Stocks. Today is May 6th, 2026. Silver is around $75, and now you have a framework to understand what that might really mean. Thanks for listening. Wednesday, May 6th, 2026. Write these numbers down. Silver, $75.41. Gold, $4,632.90. That puts the gold to silver ratio at roughly 61 to 1. Now, here's where it gets interesting. COMEX registered silver, the metal most readily available for delivery, sits at about 79 million ounces, and in the retail market, a 1-ounce American Silver Eagle is selling for over $90. That's a massive premium over spot. So